And I want to emphasize this because I think this is very counterintuitive, okay? I think most people would assume that when they feel good about the economy, that the stock market is in a good place to do well. And when they feel like crap about the economy, that the stock market is likely to follow suit. What you actually see in the data is that markets, on average, do significantly better measuring from a point of low consumer confidence.
Anyway, we've got a lot to talk about today, Brent. First, I just want to welcome all of our listeners to the Money Alchemist podcast, episode 49. So today we're going to focus on consumer sentiment, but we're going to try to shake things up a little bit and give our episodes a cleaner format, so that way it's just a little bit more fun, a little bit easier to follow along. So we're new to this whole YouTube thing, and it's tough to get a segment. Like when you're having a conversation with someone in real life, it's not like you purposefully build segments up. So that's something that's new to us, and stay patient because we'll continue to get better at that and work at it. But I do want to know what's been going on in your life the past 2 weeks since we did this last time.
I think 60% of the U.S. just got hit with some pretty bad snow.
Yeah.
So here in Cincinnati, we got, 12 inches?
And Mason, based off what my wife said, so we live in Mason, Ohio, it was like 24 inches. It was.
You did not get 24 inches of snow.
It felt like 24 inches.
There's no way you got 24 inches.
All right, man, I got to tell you. So I'm going to complain a little bit, just the circumstance of life. So I think God and gravity were ganging up on me this past week. So, my son had a birthday. I buy him a four-wheeler on Facebook Marketplace. It's what he wanted.
Like a real one?
Yeah, a real one.
Oh, my God.
So, I'm not going to go like super high dollar on it. I want to see, okay, is he going to like it? So I go Facebook Marketplace, buy a used one, get it delivered. The thing is like shot, doesn't start, so I got kind of ripped off there. Lesson learned, right? So that engine doesn't work. Then the snow happens and I'm like, all right, man. I repaired my snowblower. The last snowstorm, the belt broke on it. So I went to a repair shop. They gave me a replacement belt. I remember looking at it sideways thinking, it looks a little smaller than the last one. So I put it on there anyway. It's going good for the first tenth of the driveway. Then, smoke starts coming out of it. I smell burned rubber. That was the end of that. So I ended up having to shovel the whole entire driveway all by myself. But it felt like 24 inches. I'm just going to say that, so it was a lot.
I think it was, you don't live that far from me. So it was probably closer to 12.
I'll tell my wife that. I kind of told her it was more than 12. I would say probably just eyeballing it. There were drifts that got up to 2 feet, but then most of it was 12 to 14.
Yeah, no, I'm just giving you a hard time. We had a kid from the neighborhood came and snow blowed it for us, and we paid him, which was great. I really like investing in the youth of the neighborhood. And
absolutely. I used to do that as a kid, man. That's a way to make some good money. I'm glad to see kids are still doing that.
I'll tell you, he worked his tail off for the money that we spent. He was out there. I mean, the snow didn't stop until 6 o'clock.
I know.
At night. So he was out there in the dark for a couple of hours getting it clear for us. So you have him to thanks to the high school kid that plowed my driveway for getting me here to the podcast today.
Yeah, well, thank you, whoever you are, the unsung hero of the day, or unnamed.
What's are we like the mailmen? Rain, sleet, snow, whatever. We still show up.
I don't know. I will say this podcast would have been canceled if it were yesterday.
all the kids are home from school, so between the two of us, I think there's 7 of them that are hanging out going crazy at the house. So,
well, we had that happen. So hopefully everybody survived, and is nice and warm in their homes. This other thing that happened is it's hard to believe, we're almost through the first month of 2026. It's already flying by. There's a common saying out there that as goes January, so goes the rest of the year. Well, so far, January has been somewhat of a mixed bag, but I think last I checked, it was positive. So what do your charts say here, Brent?
Yeah, the S&P 500 here, I can put it up on our screen here. The S&P 500 so far year to date almost up 2%. That's as of yesterday.
Not bad.
So, I mean,
we had a brief period. It was negative early January.
It's so funny, right? Because, the market is one of these things where if you looked back at the end of the year and said the market was up 25%, people will be ecstatic. And here we are, not even through January, we're already up 2.5% on the year. So it gives us a lot of room. And people forget that just because the market has volatility doesn't mean that the market doesn't go up over time. And how many people got nervous about the stock market last fall, and a lot of kind of scary things that we've talked about in prior podcasts. But the market continues to find ways to climb higher.
Yep, climbing a wall of worry, as they say. So speaking of wall of worry, we were talking earlier about some Tesla brand damage. You had an article pulled up where it looks like Elon has maybe cost his shareholders a little bit of money delving into politics.
Yeah, I just thought this was funny because as an advisor, I think we always have to kind of play Switzerland a little bit for clients. We have clients that are on the left, clients that are on the right, everywhere in. And I think such an important part of investing is not letting your emotions.
Yeah, it's funny. No matter where you are in the political spectrum, the recipe for building wealth is identical. It doesn't matter.
Right.
So the advisor should be neutral.
Yeah, and it's you shouldn't. Politics are not I mean, we've talked about this in past podcasts, especially leading up to the presidential election. You don't really want to invest with your politics. Personally speaking, I mean, I remember when Joe Biden was elected in 2021, I know a lot of my conservative clients were all wigged out and, oh my gosh, the market's going to, and to their credit, they got a 25% correction in 2022. But if you zoomed out and looked over the span of Biden's presidency, the stock market did pretty well. And same goes for Trump the 4 years before that, and so on and so forth.
That's right.
So I just think time and time again, regardless of what your politics are, you don't want to invest with them. And that's kind of plays into this Tesla thing to some extent, I guess, because back last year, Trump buddied with Elon.
Yep.
And as an advisor, you always have like kind of a handful of clients that are trying to game the system a little bit. And so they might reach out to you and try to get you to, what do you think about this individual? Hey, I saw Tesla stock, because if you look back at it, Tesla stock did really, really well.
Yes.
From when Trump won the election and he became buddy with Elon through when kind of peak Trump Elon, and then things went the other way. And Tesla stock had a 50% loss, and now the stock's come back. That's all to say that, one, I think anybody owning Tesla stock, like, you kind of have to acknowledge that, like, Musk is a little bit of a loose cannon.
Yes, for sure. Yeah, a little bit.
I mean, if you've owned this stock for any period of time, you kind of have to both love Musk and hate him, because he's like a visionary that leads the stock, but he also, like, there's this news story is kind of funny because this is just not the first time this has happened.
Yeah.
I think 2016, Elon Musk got on Joe Rogan's podcast and I think smoked a bunch of weed and then ended up making a tweet about that. And then the SEC got mad at him. And so anyway, I think we're off topic, but the point is, regardless of what, my opinion here, regardless of whatever brand value Tesla does or doesn't lose because of Musk being kind of crazy in the short term, if you're invested in Tesla stock, Musk is also a big part of the reason you're there.
Yeah.
So how do you quantify, like, Tesla loses 15 billion in brand value in 2025? Like, whose job is it to figure that out?
Well, let's see here. It is Laura Kolodny.
Well, that's the report. That's the reporter. But anyway,
I don't know how you would calculate that, but I understand the gist, and I agree with it because I have noticed. I'm going to make a statement here, bold statement. The Lucid is the car for people that can't stand Elon. Every Lucid I see driving out, I'm like, that person would probably be owning a Tesla if Elon were not Elon, the right-wing guy. So, I've noticed that ever since Elon has entered politics, that the quantity of Lucid cars I see has increased.
When the bumper sticker, I bought this
Before
car
Elon
Elon
went
went
crazy.
crazy. But really, you didn't, because Elon's always been a little bit nuts.
I remember the day that I thought, I was like, man, this guy's out there, was when all the Indonesian miners got trapped in the cave. And remember, it was all the news. I forget what year that
It
was.
was like a soccer team, wasn't it?
I don't remember, but it was in Indonesia. I do remember that. A bunch of people got trapped in a cave. I thought these were miners, but I could be wrong. And Elon was like, I'll solve the problem. It's like, what do you got to do with Indonesia? Like, there's this guy that, this visionary leader of Tesla is all of a sudden was like, I'll be the guy that solves this problem. It's like, I don't know if that's your jurisdiction.
Well,
but I remember thinking like, that was a kind of a strange thing to volunteer for. But, ever since then, I've kind of had a view of the guy that he has a tendency to think of things in a very grandiose way, and I think that abundance of optimism he has been a big contributor to his success. But it's also, I think people kind of look at him dubiously,
Yeah, I don't know. I mean, it's hard to knock the guy because he is a little nuts. But when you look at what he's done with the companies that he's made and whatnot,
It's unbelievable.
I just think I'll tell you. I mean, I had a client reach out, a conservative client reach out last year when Trump and Musk were really close, wanted to buy Tesla stock, and he asked what was my opinion of whether or not he should own Tesla stock. And I think my response, if I remember right, was successful. In order for you to invest successfully in Tesla stock, you have to be able to hang on through some very strange moments, some good and some bad. And right now it's good, but who knows where it'll get. And that, I guess the point is, investing is about as much about managing your emotions as it is picking the right stock. And in Tesla's case, if you want to own Tesla stock, you really trying to hope that Musk is going to change who he is and not do, stuff like this is not the right way. But
there's a lot of reasons to manage your emotions in today's market. I mean, just in the last couple weeks since we met, we've had quite a few market updates. The biggest headline to hit most recently is this whole trade deal between Europe and India. We also have constant talk about, United States wanting to acquire Greenland, whatever that means. We got, just a huge flight to safety. Central banks just can't seem to have enough gold. That's driving up the prices of gold. It went up to, over $5,000 an ounce, which is historical, new all-time high. And then, you've also got wild things coming out of the White House, things like, we're going to cap credit card interest rates. We're going to prevent institutions from buying rental properties. So, I thought, maybe we could touch on a few of these things prior to moving on to consumer sentiment. So, what do you know about this trade deal between Europe and India?
I haven't seen a whole lot on it at this point, but my understanding is that there's reduced tariffs between the two countries.
Mm-hmm. So, India has been, last I looked, and it's not something I look at constantly, but India's stock market has been one of the, if not the best performing emerging market stock market out there. So India has been running on all 8 cylinders, and it's a very complex political environment as well. So it's tough to kind of predict, notoriously tough to predict, India's governance and how that will flow through into equity returns. But apparently there's been this trade deal between European officials and officials in India. It's been ongoing for 20 years about, how do we loosen or reduce the barriers of trade? And I think the impetus of that, the progress in that conversation has been as a way to kind of diversify away from U.S. imports, because obviously, the Trump administration is utilizing tariffs as a negotiating tool to get better trade deals for America. So, Europe, naturally looking for a pressure release, is looking at other countries. What can they do to reduce inflation on their side? So, that gave way to this trade deal that's been announced. But I also have heard too, and I don't know if this is true, I got to verify it. So listeners beware that this trade deal as it's struck is actually being challenged in several European courts. So it may not be time to celebrate quite yet, but that was one announcement that was made.
Yeah, I think what's interesting is like, there's the last 5 to 6 years, there's been a big trend of like moving things to your own country and not having, trade deals with other countries, like kind of reshoring. And this is a little bit counter to that.
Yeah.
So, but India to me is really interesting, just to add a little bit of color on what you said. You mentioned that India has come up in the last, 10 years. My understanding of India is they have a huge amount of like underserved, like I forget what the stat is, but it's like less than 20% of the population has a bank account. And there's a lot of upside for essentially that whole country to come into kind of middle class, get bank accounts and start, thinking about owning real estate and all of these things that we have in first world countries. So, but they have massive population. They're very similar to China. And I think that since COVID, really there's been a big push to get away from China, and India's benefited from that.
Well, now I know one thing's true. A lot of wealthy Indians are going to start looking at BMWs and Mercedes-Benz as the new status symbol, like we used to.
Yeah.
So we're going to start seeing a lot of those European vehicles in India, which for those of you who are looking for global economic growth, I mean, obviously having no tariffs across the world is a net positive for everyone. So we'll see how this plays out. What do you think about all this like talk with Trump talking about taking over Greenland? I don't know what to make of this. I have my opinions, which I'm happy to
have you
share.
looked at it on a globe?
You're talking about in terms of like the size of Greenland,
Not just the size, but the positioning. So it's
yes,
so funny.
It's really close to the Arctic. I know that.
So recently, my mom is redoing a lot of the first floor in her house, and so this has triggered her to go through like all of my childhood stuff. And she's delivered me like boxes of things from when I was a kid. One of these things it's actually really cool. It's like this old school globe.
Yeah.
From like the 1980s. And it's really neat because, the world's changed since the 1980s, and my globe still shows how it was. But I got this last week. I mean, she just dumped all this stuff at my house last week. And so I'm looking at and all this Greenland stuff's happening. So I look at the globe and I look at Greenland up at the top. Don't quote me on exactly, but it's like not all that big. It's really like maybe 2 to 3x the size of like Texas. But it becomes pretty apparent when you see it on the globe, like why they want it, because it's almost equidistant between like Russia, Europe, and the US.
Yes.
All across the top. And I guess my understanding of the big push here is that Trump has this goal of implementing what he calls the Golden Dome.
Yes.
Which I guess Israel has the Iron Dome, which is a missile system basically that's designed to take out any missiles that are fired into Israel, and Trump wants to build the same thing here. So the idea is we're going to build this this missile network that's designed to watch out for missiles being shot at us or at Europe and take them out before they get here. And it's and I don't know. I mean, if you look at the globe, I just don't know where else you would position this thing other than Greenland.
See, I think that's the cover story.
Yeah.
Yeah. I mean, we live in the space age. I would think that, the days of intercontinental ballistic missiles are kind of over. Like, why wouldn't China, if they wanted to launch some form of kinetic attack against the United States, they could send it in outer space, and I don't think in that case it would matter. So that seems more like a cover story to me. Although I do understand the logic of it. I think it's more about depriving competitors from the natural resources that Greenland may possess. So there's this race to acquire like all these rare earth minerals and energy resources. I think perhaps Greenland, there's like some treasure trove of natural resources accessible there. And the country is only like 50,000 people. It's tiny, it's puny. So it just seems like low hanging fruit. It's like, in other words, it's like there's a small, tiny population over here, of people, and they're sitting on a mountain of gold. that's being underutilized. Let's just go in and take it. Let's muscle in. I think there's an element of that, which honestly plays into national security. So, we live in a dog eat dog world. I don't like the idea of, using strength to muscle around and, garner more power, but that's the world we live in. It's never not been the case. So, I think, that seems to me to be the more logical thing, is that it's a stretch for, economic, materials, specifically like rare earth minerals, and energy resources. But there's probably a defense strategy around that too. Real quick, and then we can move on to
But I don't know the answer to this. I'm sure.
Well, neither of us do.
I'm sure you're correct
Yeah.
in that there's a natural resources element to it. But like, aren't there other places you could go to find some of that too?
Yeah, but Greenland's kind of unique, where it's kind of a country where nobody really cares about the natural beauty, and there's only 50,000 people. So I could see like strip mines being, put there, and like nobody cares, and there's no protests. Like Greenpeace is not going to go up there with a bunch of signs and sub-zero temperatures and like, hug the trees and march down the streets. So I think Greenland is just a easy pickings personally.
Well, maybe I'll just say that when I looked at the globe, it was pretty obvious where, like, if you look at the globe from the top down, Greenland is almost right in the middle of Russia, Europe, and the U.S.
Well, I don't disagree with the whole national security angle. I just don't think that that's the primary reason. I think there's like a bunch of reasons why this is being done.
Yeah,
but
I'm sure.
One thing's
you would
for
hope
sure.
There would be multiple.
One
reasons.
thing's for sure. It's good to be a Greenlander, because you're like the girlfriend everybody's fighting over right now, and it's a realistic possibility that those 50,000 citizens, I forget how many citizens are there, they're all going to be multimillionaires overnight if a like purchase deal is approved. So we were joking earlier, maybe we should change citizenship to Greenland just real quick before all that transpires. I don't know if that's going to happen though. I think a lot of this rhetoric has a tendency of like reaching like peak hysteria, and then it kind of fizzles out into nothing, so we'll see what happens.
That's kind of Trump's MO, right?
They say that's the art of the deal.
The taco trade.
Yep. The art of the deal is like, say, propose something so extreme, no one's going to agree to it. And then when they're done freaking out and wigging out, then you come in with the actual offer, and that seems reasonable. They're like, why did you start with that?
I'm kind of surprised. Like the I forget who it was recently published, like the taco trade is back. Yeah. After these European tariffs that were
for taco. What's taco mean for people?
Well,
I've never heard of
it
that.
stands for Trump always chickens out.
Yeah.
Right. So and it's really been coined with these tariff deals, because Trump will threaten these massive tariffs and then walk it back. And but isn't that kind of his plan? Like I don't really understand the taco argument of being critical of Trump, in the sense that, did you want him to go through with the initial stuff? I don't know that he ever really plans to go through with his initial offers.
Yeah. Well, I think there's a lot of people that get so embroiled in their own political belief set that they actually wish ill on the opposition, when in fact that's bad for everyone. So, I see this, like I watch these videos. I had to actually remove X off of my phone, because it was just so like, just the sentiment was so negative. I'm like, ugh, so I just nuked it, and I'm like, I'm done. I'm not looking at that stuff anymore. And that was like really the only social media I really paid attention to. So I've completely done. By the way, my life has only gotten better since I did that. So, tip of the day, early one. Just completely separate yourself from social media, except for the Money Alchemist podcast on YouTube. You should always be listening to that. So anyway, I forget where I was going, but I think people. Oh yeah, I remember. So people have a tendency to hope their team wins so much that they actually actively try to like mentally sabotage the opposing team, when in fact that's just bad for humanity.
Yeah, like we're all on the same team here.
It's like being in a boat, and it's like being in a boat and you don't like the fact that the other person is on the other side of the boat being rescued. So you go over to his side of the boat and poke holes in it. It's like, well, then that kind of screws you too. That's the equivalent of it. But
I'll say that from our side,
mm-hmm.
The taco trade is live and well once again.
Mm-hmm.
More reasons why you can't. Again, investing is not about reacting in the short term.
Yeah.
And predicting the future is a losing proposition. So
to an extent, you can't predict the future with fidelity, but you can kind of forecast its trend, which is actually a good segue to the topic of the day, which is consumer sentiment. So you want to take us into that?
We've looked at this a few times. I think last summer we did a podcast on like
mm-hmm.
the most hated economy.
Yes.
Something like that.
Mm-hmm.
And I don't think since then it's gotten much better.
Mm-hmm.
Full disclosure. So the headline is that consumer confidence is basically at lows since 2014. And we've got a stock market that is at all-time highs.
Mm-hmm. The
K-shaped economy continues to feel even more brutal, right? Like anybody that you ask, right? I'm afraid to talk about consumer strength because I'm worried that I'm going to frustrate somebody that's not in a good place because we've got such this bifurcated economy where if you own assets, if you own stocks, if you own a house, like you're in a pretty good place financially.
Yeah.
If you don't own stocks and you don't own a house, it's a scarier time to be out there. But from our standpoint, our clients are always thinking about the markets at all time. I mean, just today we made a new high in the S&P 500, and yet we've got consumer confidence at multi-year lows. So, like, what are clients, what are investors supposed to make of that?
Well, I think we should dive in a little bit into the sentiment index. I think, we can look at this index and it's just a squiggly line on a chart, and we have really no idea what the numbers mean. So I think we should probably go into a little bit of detail how this is done. So the University of Michigan has been surveying consumers since the 1940s. So this is something that goes back a long way. I forget the exact year they started it.
Yeah, so this chart here, if you can see the chart we have up on the screen, goes all the way back to the early 1950s. I think the first data point on here is from the beginning of 1953.
Yeah, I think maybe 1948 sounds familiar, but that it's been around for decades. So they used to phone. How this survey is done is they just ask like 5 questions, and they're general questions like, how do you feel about the economy? And the responses can only be one of 3 responses, either negative, neutral, or positive. That's it. Those are the only 3 responses you can have. So there's 5 questions. One has to deal with how you feel about the economy. One is how you feel about your job and the jobs market. And then how do you feel about, prices of goods? So, it's designed to clue in the surveyors into how you feel about your finances, your job, and the direction of the economy. That's generally kind of what they're trying to get. So it used to be they could just call, home phones before caller ID, and they would call with like a 70% response rate. The advent of caller ID muted the response rate in the late 90s, and it basically got completely nuked when everybody canceled their home phones, went to mobile phones. And now, I think the response rate for these surveys is so pathetically low that even the University of Michigan had to change the methodology back in July of last year. So a lot of people don't realize this, but the University of Michigan no longer does outbound calling. What they do now since July of 2024, actually, so it wasn't last year, it was 2024, which is interesting because look at the dip in 2024. They completely changed the way how they get responses. So instead of outbound calls, they are sending out that now they don't publish this, but it's like 4,000 to 5,000 invitations in the mail. They also exclude Hawaii and Alaska. They've always done that. Do you know why? Long distance rates.
Oh,
I'm not
It's just
kidding
too
you.
expensive.
It was too expensive. And it was like 1% of the U.S. population. So they said, you forget about those guys. You know, the Alaskans are too grumpy anyway, and the Hawaiians are too happy. So they're going to skew our results. So they've decided to continue to do that, even though it's, you know, not really cost ineffective to mail these things. They just continued through, you know, one reason or another to not include Alaskans and Hawaiians. But they send out 4,000 to 5,000 invitations in the mail now, and they invite you to respond. Here's the problem with that. What do you think that injects? A negativity bias. Because before, you were going to get a just an unsolicited call you'd answer. It'd be like 5 questions real quick, boom, 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 you know, barely an inconvenience. Now you're asking people, Americans, to open the mail, read the mail, which, by the way, is a tall order. When's the last time you've read anything that was mailed to you?
You know, it's interesting because wasn't there this big push like 10 years ago that everybody was getting everything electronically now? So like mail was actually like a good thing. Like you were actually able to get more attention by sending mail than an email.
Yeah.
Because nobody got mail anymore.
Yeah, I used to call it.
Where do we stand on that at this point?
You had a great term for it. It was like hard mail.
Heavy mail.
Heavy mail.
Well, that's a little different.
Yeah.
That's like you know, if you send something in the mail and you want somebody to open it, put something in there that makes it hefty.
I pay attention to a couple things that come in the mail. Anything from the IRS, I'm going to read. Anything from the state
Hopefully
of Ohio.
You're not getting too many things from the IRS.
Well, you get occasionally, and it's usually nothing bad. But sometimes you get stuff from the IRS. Anything that comes from like business oriented stuff. I immediately discard any sort of advert, any sort of like, you know, credit card offer. In fact, it's an inconvenience because I'm paranoid. So I think, you know, I don't want to put this in the trash and have someone else apply for it. So I actually have to take them and shred them. So it's really an annoyance for me. But back to what I'm trying to say here with this consumer sentiment, it's like it's a tall order. I think the way it's being done now, and I can't fault the University of Michigan for doing it this way, because like how else are they going to do it?
Yeah, you have to find some way to do it.
Yeah, because people are just ignoring their cell phone calls, and you can't really text people these things. So they have to do it this way, but it injects a tremendous amount of negativity bias because the people that are most likely to respond are those who are kind of salty. You know, they're looking for some form of catharsis. So it's like, well, finally I can complain to someone, you know, because if things were going good, you're probably just going to look at it and like say, I got better things to do and move on. And I think that
maybe, but this survey has clearly had better results in the past, right?
Mm-hmm. But I think I'm not saying that explains the full drop off in 2024 because you just see the sentiment rates crater starting in early 2024. So, you know, it partially could be responsible for that. I'm not saying it's fully responsible. I think the larger story, though, is generally true that consumers are just, you know, they're just tired of the inflation, and they're also being, you know, racked with all this doubt about the future job prospects. Like we've been told for like 4 or 5 years, ever since ChatGPT launched, that your days are numbered. You know, like you're going to be fully outsourced and replaced. You know, of course, we talked about Elon earlier. He's out there saying, "Oh, it's going to be utopia," and I'm like trying to like calculate how he's coming to that conclusion, and I can't for the life of me come to the same conclusion that he does. Maybe he just doesn't care because, you know, he's got a large bank account and he's the one building the robots. But you know, I'm trying to see like, okay, well, you know, in our line of work, like if we're, and this is not by the way, this is not, I don't mean to get off on a tangent too deep, but this is not like a fantasy or dystopian future that's unrealistic. Like if you and I could be fully outsourced right now and replaced by consumers. So let's say, you know, I'm in need of financial advice, but instead of consulting Infinite Wealth Planning and Brent Gargano, I decide just to bring up Gemini and input all my data there, and Gemini sends me data back. Right now, the limitation is Jim and I can't implement anything. And as you say, it has no what? How did you call it? It has no pocketbook or something?
Yeah, the robots don't have bank accounts.
Yeah, that's how you say it. And that's true. And I think until that's resolved, our jobs are pretty safe because ultimately the buck stops with us and we're liable. And that's true for all jobs. You think about even a bean counter or someone who's just putting data into spreadsheets. If they mess up, ultimately they're accountable through, job termination and potentially, legal recourse. But, these AI bots, what are you going to do? Take Sam Altman to court? Yeah, good luck with that. Anyway, I digress. Let's get back.
I think that, and we won't spend a lot of time on this today, but I do think there's a whole shift going on in the insurance industry as far as what are the risks you're actually insuring. I was listening to Berkshire Hathaway. They have an annual conference, and one of Berkshire's biggest businesses is Geico. So they do a lot of auto insurance, and they were talking about the difference of insuring autos when you're insuring for human error, like a human screws up and gets in a car accident, as opposed to the car that's on autopilot screws up, and one is it's like a human error, and one is a liability issue. And so it does change, I think, the way that you look at liability,
big time.
Because it's no longer the fault of the person distributing or it's the company that owns the AI or in the case of a car, the technology that's auto driving. I mean, who do you point the finger at when something doesn't go right?
Yeah, and my thought is right now the finger's pointed at the person that signs the EULA. Well, what if that person is completely outsourced? There's no person signing a EULA.
Yeah, the robots don't have bank accounts. Somebody's got to be held
bingo
to the issues. So anyway,
yeah, you get back on track. You have a great chart pulled up there.
And I don't know if the screen recording is working or not, but really this chart comes from JP Morgan. So if you can't see it, JP Morgan has a great resource. It's called Guide to the Markets. You can just Google. We'll put it in the show notes. But JP Morgan Guide to the Markets. A lot of advisors use this. It's really good research put out by JP Morgan. There's a chart that specifically speaks to consumer confidence and stock market returns. And I want to emphasize this because I think this is very counterintuitive. Okay, I think most people would assume that when they feel good about the economy, that the stock market is in a good place to do well. And when they feel like crap about the economy, that the stock market is likely to follow suit. What you actually see in the data is that markets, on average, do significantly better measuring from a point of low consumer confidence.
Yeah.
So much so that in the data set that we're looking at here, this goes back to 1971. Okay, so we've got almost 55 years of data here. In the 10 instances where consumer sentiment peaked, the subsequent 1-year, 12-month returns in the S&P were plus 3.9%. So just to reiterate, when consumer confidence was at all-time highs, your following 12-month average return in the stock market was less than plus 4%. In the 9 instances that consumer confidence was at relative lows, guess what your 12 months were? Your 12-month return.
A lot higher.
24.1%.
So what you're saying is the consumer is always wrong.
It's an interesting note on positioning. In the stock market, I think people forget how positioning works in investing, meaning the more people that are bullish and that think everything's going to go right, the less incremental buyers are left.
Yes.
The more people are negative on the stock market, that means there's more incremental buyers to capitulate in the future.
Yes.
Theoretically. Right? And so I think this trend is, again, counterintuitive for a lot of people. And when people see, a headline of consumer confidence at all-time lows, I don't think it gives them a lot of...
How low? What's, just to give
all-time
people...
lows is not the right... I mean, this is 50 years, and we're back to lows from, I don't know, I guess in late 2022, there was a slight dip, and then, we're lower than we were in COVID. That's pretty tough. 2011 before this. So, but the fact is, when you see on the news the headline that consumer confidence is at multi-year lows, and you close your eyes and think about how you're invested in your retirement account or your portfolio, my guess is it's not a warm, fuzzy feeling that you get. And the data would actually tell you that consumer confidence is what we call it's negatively correlated.
Yeah, it's also it's a negatively correlated leading indicator.
Right.
And it's one data point to consider over a variety of data points. I completely understand where this negativity is coming from. I believe it's 20% lower than the average reading, which is somewhere around the 70s, and the last reading was 56. These come out monthly, by the way. It's also important to note that it's only 400 to 500 households respond to this. So it's a tiny little.
It's a small data.
The sample
subset.
size is a fraction of a fraction of a
but
percent.
It's still representative. I mean,
well,
it's something. Something is better than nothing.
Yeah, I think it's still, it gives us an interesting data point. I would not, base your entire investment portfolio out of it. And it's been pretty consistent too. So I don't necessarily disagree with the results, although I don't sit there and hang, my entire investment thesis on consumer sentiment. And I do think that the consumer sentiment is accurate because just talking anecdotally with
there's no question that people are frustrated right now, and rightfully so. I mean, we've had a ton of inflation in the last few years. Wages have not had a chance to fully catch up to where prices have gone. And again, if you haven't owned assets for the last 5 years, you're feeling pretty left behind right now.
What do you think? I mean, where do you think all this heads? Because I think about this a lot, and this concentration of wealth problem that we're having, and it's only gotten more and more pronounced through the years. So I remember it being an issue. Candidly, the date that I started paying attention to it was like 2009, when we had all these wealthy institutions, like Lehman Brothers, just go, belly up. However, the people that were in charge, remember the March on Wall Street? What was it called? It was called, Occupy Wall Street.
Yeah.
Everybody was protesting because, nobody was being held accountable. And to this day, not a single person has been held accountable for the catastrophe that was 2008. For people that weren't working at that time, I was working. It was bad. I remember one day I was driving to work and noticed wow, traffic is really light. This is before work from home days. And I remember thinking it's noticeable. I think they underreported the true unemployment. They said it was around 10%. I would suspect it would be closer to 15, 20 because it was pretty bad. The unemployment data, they stopped counting the people that gave up looking for work, which is really,
we have the participation rate, which people give.
Which is, there's just too many opportunities for these, statisticians to monkey around with the numbers. So, what I typically do is I was lick my finger, put it in the wind, and I test my gut. But back to the whole, wealth concentration discussion, that's when I really started paying attention to it. I'm like, man, these really wealthy people have it locked in. They're really doing quite well. And then ever since then, you just kind of with intermittent winners, you'll get people like Zuckerberg that come in with a fantastic idea and just scale the ladder, but these folks are few and far between. And, we're also in an issue where, because the stock market is, run up, the housing market's run up. It's tougher to gain traction because you can buy not the wages for lower income people, the gig workers, so to speak, like the Uber drivers and, restaurant workers and the baristas, their wages really have not grown. The wages that have grown have been the highly skilled wages, and that skews the averages. So, hourly wages have barely grown, kept pace with inflation, whereas, white collar wages have, eclipsed. They've grown quite a bit, and that's pulling up the averages. So it's becoming more and more and more and more difficult to reach an escape velocity. And I think that's what's reflecting in the numbers here. And I don't necessarily see an end to that. I think that it's going to continue.
It's hard for it not to because, if you took two people that are both invested the exact same way, they earn 10%. I'm just making examples here. They earn 10% on their portfolio. Person one has $100,000. Person two has $10 million. Person one's making 10,000. Person two's making $1 million. The more money you have, the more total dollars you make with a smaller percentage change. I mean, that's just how compounding works. So I have a hard time thinking that you can stop compounding. It's just math.
Yeah, I watched you triggered a memory of mine. So I watched the video between Theo Von and Dave Ramsey, which is pretty good if you've ever seen it. Theo Von's hilarious. He asked Dave Ramsey if he was ever involved in a pyramid scheme.
Oh gosh.
And then Dave Ramsey's like, "No, I can't say I have." And Theon was like, "I've been in a few."
Isn't that what you are?
He's like, "I've been in a few." No, he didn't say that. Dave's not a pyramid scheme. He runs a good operation. It is one of the best marketing operations I've ever seen. But enough comment about that.
We can do that on another episode.
Yeah,
That'll be a fun episode.
Yeah, it would actually. Yeah, we should. So, but he was asked. Theo basically asked Dave, when was the moment that you really felt rich? Like you felt, there. One barometer of wealth, I would say, this is my definition. Like, how do you know when you've made it? Is when you go to any restaurant and you can order whatever's on the menu and not worry about the tab. If you're paying attention to the menu prices, you're probably under some financial stress. That doesn't necessarily mean you're in a bad financial position. It's just you're not at that point where you can you can live.
You feel like you've hit escape velocity.
Yeah. Now, what Dave's definition was, and I found this to be interesting because I've never given it any thought. He says, "I truly felt wealthy the day my money made more money than I did."
Yeah.
And I thought that's actually a pretty interesting point. And I think that is what I mean by escape velocity is when your wealth accumulates so much energy that it creates its own energy, and generates its own wealth far beyond anything you can contribute.
And that's kind of my point. I mean, when you were thinking about the uber wealthy, if they're invested, I mean, it's just going to be hard to catch them if you're not, if you're trying to do it purely through your earnings, your labor. It's just tough. And so I don't, back to your question on how do we solve it? I can't help but think you kind of have to do one of two things. Either you have to really build up the lower end of the spectrum to help, close some statistical gap, because it's a very small percentage of the population that's really this far out ahead. It's a big gap, but it's not a large swath of people that have this money. So you can make a lot of impact by just playing with the broader pool. And I think lifting those people up is good, as opposed to getting mad at the billionaire and telling them they need less money. I think it's better to focus on how do we bring everybody up. On the other side, you've seen, we didn't touch on it earlier, but California's proposed a wealth tax. There's it's a quote one-time tax. We won't do it again, we promise.
Did you hear the owners of I forget the owners of Google? The Alphabet as it's.
But it's triggered a whole bunch of people to speak out. Like Jensen Huang from NVIDIA has said he's okay with it. I think the Google people said they didn't like it. I mean, there's all these CEOs that are speaking out. Ro Khanna, who's is one of the representatives for California, has come out and said he supports it. So but the point of all of that is to say that the wealthiest people aren't wealthy because of their income. They're wealthy because of their assets. And we talked about this on a podcast a long time ago where we talked about why don't the rich pay as much in taxes. And really a big piece of that is because we tax income here in the U.S. And if you have $100 million, but it's all sitting in stock that you don't sell, you don't really have a lot of income.
That's right.
And so what are they going to tax you on? So until they either implement some kind of tax on assets, which is a whole other can of worms that's tricky to get into, but similar to what California's proposing, or we have the estate tax, and you can tax people when they pass away. But that gets into all sorts of other trickiness because planners like us are in the business of helping people avoid those estate taxes. There are ways to get away from those.
And I think there's a lot of people that are just jaded by that because, all right, let's say the estate tax, say, Bezos, takes the stairway to heaven. All his money gets, assessed an estate tax. And I think my point of view, and I think a lot of Americans are in my camp, is like that goes into a giant black hole. We're being told now that, and I believe this, that there's a tremendous amount of fraud, in the U.S. Federal government, like in terms of welfare benefits. So so let's say we implement this estate tax. Can we trust that all that capital is going to be fairly distributed to the working class?
Well, that was the problem with when Ro Khanna first came out and backed the proposed wealth tax in California, that was the pushback they got is like, hey, if you're going to tax us, you better darn well know that you're spending the money right. So that was the walkback that California did was they said, hey, if we do that, we're going to do this big audit and make sure that there's no fraud, waste, and abuse. And
how do you make it egalitarian? And I think that's the challenge. And I believe that our culture is going to more seriously address this challenge. And, on the record, I think that conversation starts with Social Security in 2032. The senators we're electing this year, this November, will be the first politicians that we're going to have in office that are going to have to seriously address that because it cannot be kicked further than that. The Social Security Trust Fund is running out of money. There are so many Americans that are dependent on that, and we only have about 2/3 of what's needed in terms of Social Security taxes to fund the outflows. So what do you do about that? Well, we're going to see. I have some theories behind it. Don't have time to get into those, but I think that that's going to be the trigger. I could be wrong. It might be sooner. But, this whole notion of, the working class wages being stagnant and the American dream being unaffordable for the younger generation is very real.
Well, and I know this is anecdotal, but I'll just say this for hopefully some hope. When I got out of college, it was 2013. The people like you that had gone through 2008 kind of had a chance to get invested during a down market. We were at all-time highs starting in 2013, and I remember thinking to myself, I'd kind of missed the boat. People that had a chance to get in during those years of volatility were in a better spot, and now the market was at all-time highs, and here I am just starting to get invested. And I felt like that was a big disadvantage, and I will tell you that sitting here 13 years later, it's been a really good thing. And I think the summary of this is that you really, if you want to get yourself ahead and you want to make, basically build wealth consistently, you need to do as much as you can to build assets as quickly as you can. And trying to worry about where consumer sentiment might be and is the market at an all-time high, that's kind of not the way to think about it. You want to get invested, stay invested, continue to invest.
Yeah, and I think that that kind of carries into the inspiration story of the day. You had some great thoughts about.
Well, before we get there, I one more stat that I wanted to bring up because I just think, again, I think that people will be surprised to learn some of these stats. Okay, and we've talked a lot about consumer sentiment being at lows, but we've also talked about markets being at highs. Just today, the S&P 500 hit an all-time high, and the question that we get all the time is, with the market at a high, should I be investing my money? I have a lump sum of money. I don't need it in the short term, but I'm looking down at the stock market. I know that it's at all-time highs. Is it a bad time to put my money to work? Did you know that if you go back, so we look at, again, I talked about JP Morgan and stuff. This stat actually comes from MFS, which is a fund company, but actually, no, I lied to you. It's from the Bloomberg monthly data, all the way measuring.
MFS is just publishing it.
Sure, published by MFS, sourced from Bloomberg, looking from 1949 all the way through 2025. Did you know that if you invested at an all-time high, as opposed to investing in any other day, over a 3 and a 5 year period of time, you're actually better off investing at all-time highs? Over 3 years, your average rate of return investing at a high is a little over 30% versus closer to 28% for investing in an average day, and over 5 years, almost 55% return investing at a high as compared to 51%. So that's not to say that just because we're at a high, you'll get better returns, hold on to your money and invest at highs. That's just to say that regardless of whether the market is at a high or it's come down a little bit and maybe it's, quote, a good buying opportunity, it's always a good buying opportunity. You need to make sure
always be investing.
The best day to start investing was yesterday. The second best day is today.
Yes.
I think that's the phrase.
That's a great message. Agree with it, by the way. I've been completely ignorant in my dollar cost averaging strategy. Just agnostic. I don't care what markets are doing. I'm just plowing money in. I think the best thing everybody can do, regardless of how much money they make, is partition 20% of your income.
Yeah, try to save
$10 an hour or $1,000 an hour. Partition 20% of your income and you invest it.
Well, it's easier said than done, I think, in some situations. But
of course,
something's better than nothing.
That's what you do, and that's how you win. So, I do want you to go over the inspiration story because we meant to go over it last episode.
Well, we didn't really mean to go over it. Here's what happens: is we have these episodes, and then of course, inevitably, right after we get done with the episode, there's like something that we see that comes across that's related, and of course, I'm bummed that I didn't have a chance to bring it up during the episode. So last episode, we talked about goals. And one of the things we talked about was visualizing those goals. And after we got done with the podcast, I read this kind of cool story that I thought had to do with this, which was about Jim Carrey. And did you know that long before Jim Carrey was actually ever successful, he wrote himself a $10 million check and put it in his wallet?
I did not know this until you told me.
So I just thought, like, how kind of nuts. You're not making all this money. You write yourself a $10 million check, you put it in your wallet and have some faith that one day it's like that guy kind of knew where he was going. I think there's a conviction in some of that. And we talked about visualization as one of the ways to, achieve the goals that you have for yourself. And I just thought that was a great example of doing that.
Positive mindset.
Yeah.
Positive mindset. If you sit there and wallow in your your misfortune and you don't envision a way to improve your situation, your condition in life, then I think that can lead to even more negative results, and then it turns into a feedback loop of negativity. And the opposite's true for positivity. It triggered a memory of mine. Like, did you watch that Arnold Schwarzenegger documentary? He had the same kind of story. One thing that struck me is he used to, in his, I think he's from the Austria. So, he grew up in a farmhouse, and he said he was lifting weights in his upstairs farmhouse. He had no music or anything. The windows were open a lot of the time. He was just lifting weights and the quiet, just imagining his future, like what he was going to look like and what he was going to do with all this newfound body. And I thought, man, that's powerful. I wish I had a better way to do it. I lack the positivity.
It's kind of a way of believing in yourself.
I think it's really so that's a good way to cap off that message of the day. Believe in yourself. Believe that you can reach escape velocity. You can become independently wealthy and save what you need to save and achieve, despite all this AI scare, the consumer sentiment being at all-time lows. You're gonna be able to work through that and build the life that you want to live. You just have to envision it. So with that, are you good for me to go into the tip of the day?
Go ahead.
All right. Last segment of the day, tip of the day. We're going to try to make this like a miniature consumer report segment. It's a lot of fun to do, a lot of fun to come up with. Hopefully you all get some value out of this. Bring up a website if you don't mind, if you can.
I don't know if the screen share is, if the screen's recording.
It works behind the scenes, so I
think it is.
Okay. Well, anyway, the one thing that is becoming more of an issue for everybody, especially our clients, that we're noticing is cyber hygiene. What I mean by that is you're leaking data all over the place. And one of those areas you're leaking data is through your internet service provider provided routers. So if you're working with like, Time Warner, what's Time Warner called? Comcast? What?
Spectrum.
Spectrum, or, here we have Ulta Fiber, or, any of these places. They provide you a lot of times these modems and these routers and once, and people just kind of let the install guy come in, put it in, and then they just forget about everything. You get the internet password. That is, you do not have a very secure internet connection. Most corporations and like you go into the office, you're going to have like a professional IT company that comes in and installs a firewall. All right. So what is a firewall? A firewall is a robust system that makes sure that the internet traffic coming to and out of your devices is authorized traffic. Firewalla is a product that was recommended to me. Shout out to Chase Dillingham. He recommended it. And also shout out to people at Titan Tech. Paul Chima, you're awesome. He kind of helped me put this together. But I will tell you, this is a firewall that a consumer can install. The prices range from it looks like they're like $400 to $600 to have these things. Their top end ones like $900, but they're totally worth it. So these are routers that you install after you install. So they work in conjunction with your wireless system, your access point. So you basically just order these things, take it out of the box. It gives you instructions of what to do. You plug it in, and by default, the thing starts cleaning up your internet traffic. So can't recommend these enough. You can buy them at firewalla.com. And by the way, I'm also going to say how I use it. You can actually control internet traffic. So if you have kids and you're trying to keep your kids safe online, you can set up rules on this thing, and it's not complicated to do. You can set up rules with this thing that limit what websites your kids access, when they can access the internet. I can get down to the granular level where I can go into my son's computer, one of my son's computer, and say no Roblox.
Yeah.
Which, by the way, I did. So
we in our household, this is pretty hilarious. Actually, our kids are kind of addicted to YouTube. We don't like it, obviously. So we took the app off the TVs, and I don't know why my wife decided to do this. She has this habit of she doesn't want to take the blame for things, so she comes up with some story. So her story is that Trump banned YouTube. So my kids actually believe that Trump has banned YouTube off the TVs.
That's hilarious.
And they can't watch YouTube anymore. But I guess I could have gotten this firewall thing and blocked it more easily.
You can block YouTube. You can block TikTok. Yeah, I mean, there's all sorts of things.
For the less tech savvy, because anybody listening should realize Ben is more tech savvy than I am. So when he told me about this, I said, do I need one of these? What does my firewall look like? But I will say for clients, when I'm working with clients, one of the things that I do here, and it's not a firewall or whatever, but this is actionable, is if you use Chrome or whatever browser you use on your computer, a lot of people save favorites, and they'll just favorite things and save a bookmark, and it kind of goes in this bookmarks folder just generically, which they never use because it's just a hodgepodge of stuff. One of the things I actually try to do with a lot of my clients as we're onboarding is I'll get remoted into their computer, and I'll help them set up just a folder, like a favorites folder. A lot of times this is at the top of your browser. You can right-click at the top of the browser, and you can see, and you can basically hit Add Folder, and you can title it whatever you want. What I'll typically do with clients is I will title a folder called Money, and then under that Money folder, we will save all of the different things that relate to their money. So we manage assets through Charles Schwab. So we'll save their Charles Schwab login. If they have a Fidelity 401k, we save that. If they have a bank account, Chase Bank, we save Chase Bank's login. The importance of doing this is that what I have found a lot of clients do is when they're trying to go to their bank website, they are just typing the name of the bank into Google and then clicking a link that comes up for the bank. The risk there is that there are And I've actually seen this happen to clients where they click on a Charles Schwab link and it's not a real link.
Yeah.
It's what's called a spoofing link. And so now they're logging into a fake Charles Schwab website and putting their credentials in. So by putting a folder for money, and I do this for, I mean, if you see my screen, you can see I have it at the top of my Chrome, but if you have a money folder and you just save all of these websites under your folder, and anytime you want to access them, just use the folder as a drop down, you can be confident in knowing that you're going to the real website and not some nefarious spoofing link. And, I just think that's super simple to do. And 9 times out of 10, when I show up on a meeting with my clients and I help them add the first folder, they kind of realize, oh, I didn't know you could do that. That's pretty neat. And all of a sudden they kind of run with the folders, and it helps them stay organized.
Yeah.
And safe. So
yeah, that's a great tip. So there you go. Two tips to
financial
improve
planning meets, tech savvy to keep your online money protected, right?
It's critical. It's an important step. I think a lot of people overlook it. We're seeing an uptick of I am personally seeing an uptick of cyber criminals, and they're very sneaky, and they're using AI tools and very advanced algorithms to fool you and to get your money. And unfortunately, I've seen a lot of not a lot, but some successful attempts that have resulted in unrecoupable damages.
And that is the truth. I've also seen this a lot of times. If you get in one of these, scams or whatever, you're not getting the money back.
Yeah. So, in other words, what Brent says is free to do. What I say with this Fire Wallet, it's anywhere from $400 to $900. It's worth the money, in my opinion. So, all right. That said, thank you for listening to episode 49 of the Money Alchemist podcast. I'm your host, Ben Jones.
And I'm Brent Gargano.
And we'll see you next show.
Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.